Chair now recognizes the gentleman from California, Mr. Sherman, ranking member of the Capital Markets Subcommittee for 5 minutes.
A fundamental problem we're not going to solve in this room, and it is that we have too much national debt. The debt has tripled since the 2008 global fiscal crisis. A big chunk of that is the 2017 tax cuts for the wealthy, followed by the $5 trillion big, beautiful bill that was, I think we all agree, big. During COVID, both sides voted in a bipartisan way for some enormous expenditures. Obviously, if we knew then what we know now, we would have handled COVID differently. So we have too much debt. We have a couple of things that are helping. One of those is the independence of the Fed, and we've got to fight that to protect that. The other is that we are the world's reserve currency. The euro would like to play that role. The yuan would perhaps like to play that role. Crypto would like to play that role. And I've had a lot to say about crypto over the years, and what I said, God, almost 10 years ago, was that the undoing of crypto would be other crypto. What I didn't realize then was that stablecoin would undermine the rest of the other coins, because stablecoin allows drug dealers, tax evaders, sanctions evaders, bankruptcy law evaders to have total confidentiality and secrecy without having to risk putting their money into some other somewhat imaginary currency. So what we may see is that the dollar retains its role as the world's reserve currency, and that all we lose from crypto is the ability to enforce all of our fiscal laws. So we are where we are. In June, partly in response to a letter a number of us sent, including Representatives Wagner, Foster, myself, and Barr, the Federal Reserve announced that it would change the calculation of the global systemically important banks, that's GSIB's leverage requirement, effectively decreasing the leverage capital that these banks are required to hold. Obviously, as we issue more debt, we need to have banks participate. Mr. Tabacchi, should the Fed consider making similar changes to smaller banks on their leverage requirements so that they're not disadvantaged when compared to the GSIBs, and to bring them as full players in dealing with this float of debt we have?
I think that's an option that should be explored, Congressman. I also think that some of the other things that we've already talked about are frankly more important. If you look at central clearing.
Yeah, I'm going to go on to my next question,
Okay, go
because
ahead.
I've got such limited time. Former Federal Reserve Board member Jeremy Stein has said that large banks are allocating less capital to low-risk assets like Treasuries because they're disincentivized to do so. The leverage capital requirements are insensitive to risk, and so a regime of prudential regulation designed to cause banks to have less risk actually incentivizes them to forego Treasuries and do things that involve more risk. Mr. Tabacchi, could you walk us through what happens in the broader financial markets if the U.S. Treasury becomes less liquid or more expensive? And in particular, does that affect mortgages, car loans? Does it affect the average person trying to borrow some money?
It does, because rates would go up. We are playing with fire a little bit here, sir, because, again, if repo is the capacity constraint, think of the funding level of Treasuries has the issue when the funding levels go up because there's not enough capacity and several market participants can't access the standing repo facility, then what do the dealers do? They increase the rate that we charge hedge funds, the variable buyer of Treasuries. When they increase what we charge hedge funds, sooner or later, hedge funds are either going to increase risk, which they can do with the big banks with zero haircut, or they're going to stop buying Treasuries.
I understand. I'm going to try to squeeze in one comment, and that is I think it's absurd to regulate banks in a way where, at least for some purposes, holding a corporate bond is treated as being as risky as holding a treasury. I yield back.